Welcome back, Seafood. This is episode 437 of QAV. We're recording Monday the 13th of September 2021, 3:12 p.m. in the afternoon. What's new in your world, Seafood?
Same old, same old. You can go for a picnic now, though, with 5 people. Otherwise, it's lockdown, as always here. Oh, God. Unless you want to go to Bondi Beach for a swim, then don't worry about it.
I see Gladys turned up to the press conference today.
Yeah, I think she's had a bit of blowback about that. Yeah.
Fun. Well, we've got an action-packed show today, Tony. Lots happening. I want to talk about Bloody Thursday, first of all. Last Thursday, I heard some people in the media were calling it Bloody Thursday, blood on the tracks, to quote Bob Dylan. The market took a hit. You're frowning at me like you don't know what's going on.
I didn't even hear about that. Didn't see it, didn't register.
Don't care. Doesn't matter.
Correct.
Well,
yeah.
it mattered to the QAV portfolio. We're back down today, neck and neck with All Ords, or the ASX 200 anyway, for this financial year. Over the long haul, we're not. But again, this is again according to the Navexa way of measuring it, which you have some issues with, but we'll talk about that later on. But okay. So Bloody Thursday gets nothing from you. No, don't know.
Never even heard of it.
Don't care. Okay, moving right along.
Never heard.
Want to give a shout out to James on Facebook. He said, I've uploaded all my new and old trades into ShareSite to compare my investment returns from before joining QAV against those made after joining QAV. And while it's been only 7 months and I've made several mistakes, e.g. not selling when the 3PTL said to sell, good old rookie mistake, the difference is remarkable. Pre-QAV, 31 losers, 17 winners, 3.1% average annual return over 5 years. Post-QAV, 3 losers, 11 winners, 16.8% return over 7 months. Not only has QAV improved my bank balance, but it has introduced me to investors who've helped me grow as an investor. All in all, QAV's been brilliant for me, and I'm happy to tell anyone foolish enough to stop long enough to listen. Congratulations, James.
Yeah, thanks, James. And keep going. Keep telling people.
Yes, and keep telling us how it's going.
Yes.
Because, we love to get those stories because otherwise it's just us talking into thin air. I mean, at the end of the day, the only way that we know we're doing a good job is if people tell us what kind of returns they're getting by following the recipe. How's your chocolate cake turning out if you follow the recipe? Is it good? Is it tasty? Is it moist? It's one of my favourite words, moist. Is it moist? Is your QAV moist? That's what we want to know.
Yeah, okay.
So I just got to write that down as a title. Is your QAV moist?
Sounds like a fruitcake at the moment.
Well, one of us is a fruitcake. I don't think people need to guess too hard which one of us it is. Okay, so we were talking last week about Navexa's way of reporting our results, and Navarre Truchelot generously responded with a big long email and then sent us to a blog post on their website that explains it. And they use something called AYE, average years invested, is the way I understood it. But it sort of sounded like what you've been telling me to do to calculate the return on my portfolio, which is have a look at how much you invested per stock, how long it was invested for, when you sold it, how much you returned, and then doodly-daddly sprinkle some pixie dust on it and you get a result.
Yes.
Right.
Yes, correct. And look, and to be very fair to Navexa and Navarre, it's the same thing that ShareSite does as well when I do reports in ShareSite about performance. And it's apparently, I didn't know this until they came back to us, but apparently it's what fund managers use when they're reporting their returns. And it's exactly what you said. It's trying to take out of the equation, particularly for a fund manager, money coming in or money going out. So like if you're a big fund manager and there's a run in Wall Street and people start selling your stock or redeeming their units from your fund, well, the fund gets smaller. And if you manage your performance just simply on starting position of the fund for the year and how much it's grown or shrunk by the end of the year, then a lot of that movement can come from money flows, money going in and money going out, just from people buying or selling units in the fund or redeeming their shares in the fund. And so that's what they're trying to do, is take that out of the equation. So they want to just look at you bought this stock on this day, you held it for this many days. If you had this return, if I prorata it up to a year and add all those up, this is what your return is on an annual basis. So it's how well do you invest? And I get that. That makes a lot of sense. The downside to that process is if you turn over the portfolio a number of times in a year, it's still measuring how well you invested with all that churn, but it may make you look better or even potentially worse than what you would be if you just took the closing value of the fund away from the starting value of the fund.
Right.
Because you may have had, in terms of how much was invested and if it's churning, you may have had 3 years worth of investment in 1 year, if that makes sense, because you turn the portfolio over 3 times. And even though it's still giving you the average, which should look right, when you look at our performance in using the Navexa methodology, it's saying we were 37 or 38% up, which when you looked at the starting portfolio price and the ending, or the current portfolio price, 2 years on.
Value. Yeah,
the value, sorry. It didn't truly reflect either the compound growth rate or the just simple growth rate. So what the portfolio is up 50% in 2 years, which is about a 21, 22% compound growth rate.
Mm-hmm.
Yeah, but Navexa is saying we're up 38%. And Navexa is saying that because it's taken all those individual holding time periods and added them all up and then given us the how well did we invest number, I guess is the best way to put it. If we were comparing ourselves to, say, a big fund, that might be a legitimate comparison to make if that's the way the big fund calculates their performance. But we're comparing ourselves to the ASX, which hardly ever churns. You will get, 4 or 5 stocks coming in and out of the ASX 200 on a quarterly basis. So it's not going to churn that much. And so I think the better comparison is just simply our current portfolio value was X, our starting port value was Y, and then we can use the CAGR formula, which takes into account how long, according to the number of years. So it's, from memory, it's ending value over starting value raised to the power of the number of years we've held at -1.
So when we've always quoted 19.5% for you, your portfolio over 25, 30 years, you're calculating just using that CAGR formula that you used then.
Yeah, that's right. And I did originally do it, Navarro was doing it because, as you know, my portfolio is also is also covering living expenses, it's covering tax payments, it's covering mortgage repayments and all that kind of stuff. So it's a net number. And I originally started to try and back all those things out and just look at block A was held for 10 months and it produced this return, and then prorata that to get to 12 months and then add them all up. And A, that was just too hard to do manually. But B, after a while, as the portfolio grew, the ins and outs for other things weren't as, were small compared to the compounding of the investment. So I just stopped doing it and started using that CAGR formula I just outlined. And it's also, I think, if you're measuring yourself against the ASX, it's a better way of doing it too, because that's how I've measured the ASX performance as well.
And so do you know how Stock Doctor's dollar-weighted and time-weighted returns compare to this?
I don't. It's an interesting can of worms, isn't it?
Well, I put our portfolio, the QAV portfolio, back into Stock Doctor last week to try and get, some sort of comparison.
Yeah.
And it says dollar-weighted return per annum, 23.57%. Time-weighted return per annum, 7.02%.
Well, I think that's a question for your Stock Doctor account manager because, yeah.
And it says current value 29,861.05, whereas Navexa says 30,669.29 today. There may be some dividends that I haven't processed. I had to process a bunch of dividends in Navexa today, which I haven't done in Stock Doctor, so it might just be that. But 7% per annum? What?
Yeah.
How does that make any sense? It says, we started at 20,000. It says total return 10,341. So anyway you slice it, we have 50% more value in the portfolio now than we had 2 years ago, yet it says a 7% time-weighted return. Yeah. That makes no sense.
It doesn't make any sense to me either, unfortunately.
So confusing, all this shit, really. It's just oh my God. It's like...
Yes, I agree.
Talking about COVID vaccination.
Well, that's why I think you should just take the simple formula as N from start and then use the CAGR formula to get the compound.
Well, I did that in my emails with Navarre and those guys. And can you remember what I said it was?
Not off the top of my head. But if we're up 50% in 2 years, I would think it's going to be around 21%, 21, 22.
Let me see. I calculate the CAGR as 23.39%, which is basically the dollar-weighted return figure that I'm getting from Stock Doctor.
Okay.
Give or take. Yeah. About 23 point something percent. So that makes sense as a CAGR number. It seems to map up to the CAGR number anyway.
Right. No, I'm not an expert on all this, and I gave up on trying to do it in any sort of intricate way a long time ago and just used the simple CAGR formula.
Yeah. Well, that's that. Go back a step. Warren Buffett's global market indicator hits record signaling crash. According to the Financial Review last week, Warren Buffett's favourite market indicator has surged to a record high of 142%, signalling US and international shares are heavily overpriced and could plummet in the months ahead. We've talked about this on and off.
Yeah, you could have run that headline for about the last 2 or 3 years, probably every day.
Yeah, probably, right? But it's getting higher. It's still going, which is, but the point you always make, like, okay, it's headed for a crash, but that could be tomorrow, 6 months from now, 5 years from now.
2 years.
We don't know.
Exactly.
So what do? You just keep doing.
Yeah, we don't try and forecast, we nowcast.
Nowcast.
As the governor of the RBA said, we don't try and forecast. When something happens then we act.
Yeah.
Yeah. So, and look, there's some interesting, I did read something, I think it was in Livewire a couple of weeks ago about this, that when Buffett, he took this from memory from Phillips or Cape Schiller, the ratio of the stock market valuation versus GDP. When Buffett first started talking about this, interest rates were much higher, and that'll have an effect on valuations. And also too, corporate tax rates were much higher as well, and they've been lowered aggressively under Donald Trump in the US. So this guy who wrote the article I read in Livewire made a case which said that the market's fairly valuable when you take into account those two things.
Right.
And I was at Berkshire Hathaway AGM, I don't know, was it 5 years ago now? And Buffett was asked this very same question, and he said, yes, the market looks expensive until you take into account interest rates.
Right. This time it's different.
Yeah, possibly. But if you also look at the Buffett indicator, it hasn't been that great at predicting crashes.
Yeah.
It's a 10-year rolling average for a start, so it might, lag by a year or two in getting it right.
Yeah.
Yeah, and as you say, it might be right for a couple of years, even longer before the market crashes. So
I say that?
Yeah. Well, you just said it before.
Yeah, I said as you say. Yeah, okay. I can take credit for that, as I've always said. Isn't that the rule?
Yeah, since you heard it from Tony. Yeah.
The rule of quoting, you remember that? It's like the first time you quote something, you say as Tony Kynaston says. The second time you say as someone says. The third time it's as I've always said. So that's the three rules of quoting.
But yeah, look, it's a valid thing to always think about and have in the back of your mind. It's going to come. And I think, when we did shows around the COVID cough and I said to people, good time to gear up, I think it's now a good time to reduce debt. And, I'm not selling anything. I'm still fully invested, but don't do things which might be detrimental in a decline. And, that's the other thing too with all these things, that the Buffett indicator could right itself by the stock market going sideways for 5 years or by the American economy increasing, but not the stock market. So it's not a crash isn't the only outcome of the Buffett ratio forecast.
My son Taylor was telling me the other day that somebody he knew was telling him that it's a good time right now to go out and invest heavily in property.
Well, after it's risen by about 30 or 40%.
Yeah, it's booming. It's a great time to go out there and invest in property. Like, really? Wow.
It's always a great time to invest in property.
All the indicators I see is that things are peaky. I don't know. It's a good time. But what do I know? Tell you who's not now casting, New South Wales government.
Yeah, I don't know things are peaky either.
Well, I was going to say, who's not now casting is the New South Wales government, because I saw this story today that's just come out where they knew about the super spreader event in June and then they didn't do anything about it. They didn't put Sydney in lockdown for a few days.
Yeah. Yeah, I mean, they're not now casting, they're feeding the chooks, that's all they're doing. Well, I've stopped that. That isn't even feeding the chooks anymore each day.
Yeah.
That's a reference to Joe Bjelke-Petersen to younger people who haven't heard that expression.
Now, then you need to explain who Joe Bjelke-Petersen is to them. It's a minefield. Okay, moving right along. Let's see what's next on my list. CVW hired investment bankers to test appetite for a sale of the business now that it is predominantly a life insurance business.
Yeah, so CVW was a pulled pork, recently. And yeah, so I thought I'd just mention that I read an article in the Fin last week that, so Crescent Capital own a large part of Clearview Wealth, and the share price has been going up dramatically in the last week or so, mainly because Clearview Wealth have sold off their financial advice business, and this is part of a restructure that Crescent Capital is leading for Clearview Wealth, and Crescent Capital and Clearview Wealth have just lined up some investment bankers to look at whether there is any interest in buying Clearview Wealth from the large life insurance businesses around the world. So listeners may be aware that all of the major banks in Australia, I think all of them, have divested their life insurance businesses, including AMP, which sold off theirs recently, or last year. And they're all getting out of the life insurance business, as it's kind of it's a scale thing now. You've got to have large worldwide economies of scale to make it work. Although I guess Clearview Wealth is disproving that because it's a profitable business for them. But the conventional thinking is it needs scale. And so, basically the large insurance businesses around the world, life insurance businesses, have been buying out the Australian life insurance companies. And so that could also be the reason why Clearview Wealth share price is going up. So this could be a takeover target coming up.
That's good. Where's the share price at today? Let me have a look. CVW, 68.5 cents. Down a little bit, actually, from last week, but yeah.
Yeah, but look at the share price graph for it. It's jumped from 55 to 68.5 in the last week.
Yeah, 2 weeks.
Yeah.
Yeah, wow.
2 weeks, yeah. Yep.
Very good.
Anyway, so not financial advice, just general advice. Do your own research.
Speaking of do your own research, last week in our buy list, we had CCV quite up near the top. And by the time one of our intrepid listeners, Rob, did his own analysis on the Monday, I think, it had dropped from a nice QAV score to a QAV score of 0. He sent me an email, said, what am I doing wrong? And I said, I don't know, let me have a look at it. And I did a download and I also got 0. So I emailed you and you said, oh, I've also got 0 because their results came out on Monday.
They did, yeah. And their operating cash flow has just dramatically fallen in the interim. So their price to operating cash flow has then gone up dramatically and they've fallen off our buy list with a QAV score of 0. Yeah.
Which just goes to demonstrate why we tell people,
yes,
do your own.
Yeah, that's especially in company reporting season where things can change daily.
Yeah,
absolutely.
So that literally went from one day it was at the top of our list to the next day it was off our list.
Yeah, and it doesn't necessarily mean you should sell CCV. Again, it's up to you. But if I have a look at it, I think from memory the price is still holding up. We have it in our Navexa portfolio, I think, don't we?
We do. No, we don't. We did once upon a time, but we did sold it. Yeah.
Okay, so if I was holding CCV, I would still 3-point trade it from here.
Yeah.
Even though it's dropped off our buy list.
Yeah, we do have it in our
I thought we rebought
list.
It recently.
Yeah. Sorry, it's saying 0%. That must just be the growth today. Yeah, no, we do own it. Yeah, so it's, let's have a look at its share price history. It's trading at 26.5 cents today. It's, a lot lower than it was a couple of years ago, but yeah, it's sort of as high as it's been for the last couple of years right now, way above its sell line by the looks of it.
Yeah, it is, isn't it?
But still above its buy line as well.
Mm-hmm.
But
yes, definitely.
We wouldn't buy it today because its QAV score dropped down to 0.
And this is one of those interesting ones that I spoke about, I think, last week, where when I back tested a little bit for this, if a stock does do this, like sometimes they go down and sometimes they continue to go well. And I haven't worked out, what the difference is between those two groups. So sometimes holding on to a stock that goes below 0.05, like this one has, can be a good thing. And Macquarie Group is an example of that. And sometimes it's a bad thing where, if it doesn't have much operating cash, there's a reason and may not be good for the future of the company. So we'll have to watch this.
I was wondering if you left those stocks today in, even though they were Josephine's, because of a dividend issue, but it was just an oversight.
Oh, I think one was AXI, and I think I don't think it pays a dividend. But the reason AXI was left in, and again, this is me making up the rules as I go, is that it was only down by 0.5 cent this month. So it was 8 cents a share at the end of last month. It's now 7.5 cents a share this month. And I had just put a rule of thumb in which said if it was still within half a cent of its closing price, I wasn't going to make it a Josephine because, that can fluctuate around quite a lot based on half a day's trade or an hour's trade. So
right.
That's why I did that. And there's a couple of other cases in there too. The difference, I think, with this stock, with AXI, is that it's such a low price that half a cent is actually a meaningful number for it.
Yeah.
Yeah, whereas some of the other ones, I forget now what they were, but they were probably $1.50 a share, and so half a cent wasn't a big fluctuation for it.
Well, the only ones that people asked about today, Doug asked about MYR, arguments from people about the Josephines, but I'll get into that in a second. I think MYR is a Josephine. I think AXI is too. And the other one that Andrew Flipman picked up was Sun. I think you had that as a Josephine. I don't know why. I think there must have just been a blip.
It was an error.
Yeah.
Yep.
Because it looks good, right? It's going up.
Yes. Look, it could possibly be just an error. And I made the comment back to you that we need some quality control in the buy list before too much longer, which we'll do.
We have a plan.
And we have planned to do, yeah. Yeah, so that was just a mistake, I think. And without, wanting to, it was my mistake, no excuses. But what was happening was I was downloading, re-downloading, and I think some of the Josephines got out of sync with the row they were originally entered in, and I didn't find that one and correct it.
And you've been in lockdown for 12 weeks and you're off the booze, so, these things compound. It's like, we understand compound interest. This is compound...
Right. Compound COVID.
Compound side effects of COVID, yeah.
Yeah.
Now, the Josephines thing, look, I might be wrong here. You and I had this discussion on the show, and I've been having it with people on Facebook, and I'm quite happy to say I could be wrong. But people say, well, they want to leave the Josephines in, or they want to point them out in the spreadsheet, as you've done in your latest sheet, which I have to make publicly available. But I still don't understand it, because when I'm doing a sheet, I check the sentiment on all the stocks that are in the top 30 or whatever, right? It doesn't matter. So for me, I don't see the value in highlighting them as a Josephine, because I'm gonna check everything anyway, because I know the sentiment can change overnight. Sentiment can go up. You can be negative. You can be below the sell line and then above the buy line a day later. So I have to check everything. So I still don't understand why people think Josephines need to be called out separately.
As you know, I'm 50-50 on this one. I think we should call it out separately, and then people can make their own decisions. There are people, as we know from feedback, who will buy a stock if it's above the buy line regardless of its most recent trend. So, they just think it's cheaper buying, which I kind of get. I haven't been doing that. The other thing that, is, I guess, some background to Josephines, which I think is important. The first piece is that I've never put things in the checklist to check for a Josephine. It's just part of my buying process. So if I find a stock I'm likely to buy, it meets my criteria of ADT, it's a buy on the buy list. Before I actually pull the trigger, I'll look at its most recent trend in the current month. And if that's trending down, I'll hold off. That's just how I do it. So the process that I use kind of comes after the checklist. I'm also concerned that process came about because if you look at some stocks like Adairs, for example, it's big enough for me to buy. It's on the buy list, but its most recent performance is horrendous. It's come off a peak. It's still trending down. So unless you're one of those sort of average dollar cost value investors who will keep buying on the way down and then average out their cost as it rises again, I'm not going to buy it. I'm going to wait for it to have some kind of uptrend or turnaround before I, can see that it's not a Josephine. It's worth buying again. Where it becomes tricky is like the ones we just talked about, like looking at Suncorp today. Price has gone down today. It's kind of just in an uptrend. And if you look at, that one we just talked about, AXI, it's like half a cent in a downtrend. Are they still worth not buying? I probably would buy both of those if they were on my list of things to buy, even though they're slightly down, because they're not down much. They're not like an Adairs, or they're not like the other one I struggled with for a while was JB Hi-Fi, which I own. I'll declare that. So, that was the reason for starting Josephines. If we start getting finicky, do we take into account ex-dividends? So like Suncorp is ex-dividend. Do we add that back before working out a Josephine? Do we take into account which week of the month we're in? Because in the first week of the month, it could be a large swing, but it's based on, again, a couple of cents in the price movement. So, I'm not sure we're going to be able to land on some real definitive rules here, but I think it's worthwhile doing so people can make their own minds up. And I think it's worthwhile flagging so they can see what we're doing. But, I'd leave it there.
Fair enough. What's next? Oh, you want to introduce spacecraft publishing?
Yeah, I just wanted to mention it. It's now people who have read our disclaimers, and maybe you and I are the only ones, but...
And Henry.
And Henry, yes, from our licensee, or our licensor. Yeah, they'll see that the AFSL... So we have a corporate authorised representative license with the AFSL holder, which is another company, and that CAR, the corporate authorised rep license, is held by a company called Spacecraft Publishing, which I own, and that's why people will see it, our disclaimers. And if anyone's wondering what it is, it's just simply a holding company for QAV, or at least as far as the licensing goes.
Yeah.
Yeah.
Good. Audit reports. Talk to me about audit reports, Tony.
Oh, my God, the audit reports. Again, another 50-50. Apollo Tourism and Leisure results came out, and they scored well. I think they're about a 0.4 on the QAV list.
No.
And I thought, okay, is it time?
They don't score well. You had to apply the Apollo Tourism discount on that, Tony. I've told you.
Yeah,
it's a 100% discount on Apollo Tourism and Leisure all the time.
Anyway, so when I did my download and saw ATL, I went straight to the audit report to see if it had improved, because the history of this one is that 2 halves ago it was a qualified audit. 1 half ago they changed auditors and it wasn't a qualified audit anymore. It was just a key audit matter, and that looked a little bit suspicious to me. And now it's the same auditors 2 halves in a row, and it's still a key audit matter. And when I say it's the question mark about whether ATL will continue to be able to trade. And the original auditors called it out as an emphasis of matter, which is what we look for in qualified audits. And the emphasis of matter in that case was the ability to continue as a going concern. To be fair to Apollo Tourism and Leisure, and I really spent a lot of time drilling into their numbers, on the plus side, they've done a lot of cost reduction. So they've sold a lot of their inventory, which they rent out, which was the hardest part which was the part of the business that was hardest hit by COVID. And they've also have probably half the business or so is manufacturing and selling RVs. That's been doing well, just like any other sort of car sales have been doing well during COVID. So half the business does well, half the business was doing poorly. They've downsized the half that's doing poorly, which is good. They've received a truckload of government support, which has helped because they've been able to pay down debt. The question mark in my mind is if COVID lingers around, which it might do in the Northern Hemisphere winter, which they're going into, and ATL operate in Canada and the UK and New Zealand and elsewhere in the US, certainly would be exposed to another COVID extended lockdown in the Northern Hemisphere winter. And the question mark in my mind is, would they continue to get government support, and will that affect their business? On the plus side, they said that they have lots of real estate which they own for their travel agent kiosk, which they could sell. So potentially, again, they could survive another year of COVID without much government support. And also, too, they call out that, again, this issue of the leases on their vehicles are treated as short-term liabilities, whereas the assets are long-term assets, and they don't match up. And it's kind of an accounting trickery there, which makes them look like they'll struggle to pay their debts. So I accept that. And the other thing that I'll say is that their cash on hand looks like it would allow them to trade for another couple of years, maybe 3 years as well. So, yeah, I think they probably could survive. This is a classic contrarian trade where you're taking on some amount of risk, but if it comes off, you'll get paid really well, because when Apollo Tourism and Leisure come out the other side, the share price will go gangbusters. I call it out. I've left it off the buy list. I've called it a qualified audit. Again, it's not a qualified audit, but it's a red flag for me. The fact that it has all these issues around how much government support will they receive, how much do they have to sell or downsize the business to continue trading, versus getting all the upside when it comes out on the other side. So originally I actually went on to the manually entered data Google sheet and took it off as a qualified audit, and then a day later I put it back on as I went deeper into their numbers. So I think it's worthwhile calling it out to people. If you're aggressive and aren't allocating too much capital to it, then it's probably a good bet. But, safety first, I think, in this case. I don't feel... I really take the responsibility of QAV seriously, and I think safety first. I wouldn't recommend it on the buy list for people, but it may suit some risk profiles for people out there.
Well, I think I banned you from ever adding it to the list ever again, I seem to recall. And secondly, I think technically they received not a truckload of support from the government. I think it was more like a camper van load of support they got from the government. couldn't not take a swing at that one. All right. Yeah, I know people.
I do enjoy trying to slip it back into the bio every 6 months.
You enjoyed trying to get me drunk and slip it in when I'm not paying attention. I know.
And again, if you make the case for ATL, you're really forecasting that we're going to come through COVID in the next 6 months, that the Northern Hemisphere won't have another sort of, savage winter for a new version of COVID. It's all forecasting.
Mm-hmm.
I almost wait to give up the first initial boom in the stock price and check the figures again in 6 months' time and see if, they're better and we have more solid footings.
Seriousness, I make fun of Apollo because of our history with them, but I look at stocks like this and I'm like, look, if there was nothing else to buy, it's like,
Yeah, I agree.
If there was no other girls to date, okay, but there's plenty of much more attractive, emotionally stable girls out there that I can date. I don't need to date Apollo Tourism when she's already, let me down, I think 3 times in the course of doing this show, where we've taken her out. We've invited her out to dinner and she just was a no-show. Just didn't turn up. So
you're just not committed. You're not committed.
No, I'm not. I don't want
it. You can sense it.
I don't want it that badly.
It's a good point. And it reminds me of a Munger saying that you don't have to dance with every girl at the dance.
Exactly. That's my point.
Yeah. Good point.
Let's move right along.
Yeah, so Appendix 4E.
Mm-hmm.
So in doing the downloads over the last couple of weeks, I've read a lot of audit reports and annual reports and things, and Appendix 4E is actually really useful. Most companies, or a lot of companies, will say something like in their Appendix 4E, it's about the 10th or 11th item on the required list. They'll say wording like the figures have been audited and they are unqualified, or words to that effect. And that's really easy to find and search for and get a definitive answer to. And so I'd recommend to people to have a look at Appendix 4E, but a lot of companies are still saying things like just bland stuff like the financials have been audited and we refer you to the audit report in the attached, document, which means, going to the bottom, working back up, reading the audit report, looking for emphasis of matter and all that, which is not that hard to do, but it's much easier just to go to the bottom of Appendix 4E, which is a 1-page document, and have a look there. So I'm just wondering whether it's worthwhile, should we start a writing campaign to ASIC saying, hey, come on, let's make Appendix 4E a useful document for us and have a standard set of wording for the audit qualification.
Sounds like a job for the Australian Shareholders Association, doesn't it?
It does.
If only we knew somebody with some pull at the ASA.
It would certainly help us a lot if we could have some standard wording for 4E, which was just really easy to look up and use.
4E or not 4E? That is the question.
Yeah. All right. I'll reach out to ASA. What is he now? State president? Your state president, and see if he can help.
I don't think he's state president, is he? He's just
I think so.
He's just a director.
State director, is he? Okay.
Sorry, Steve, I haven't kept it up to date with your CV. 4E or not 4E, that is the question, whether 'tis nobler in the mind to suffer the slings and arrows of outrageous audit reports, or to take arms against the sea of troubles, and by opposing end them.
Or by Apollo Tourism and Leisure.
Yeah. Moving right along.
We spoke about Navexa.
Mm-hmm.
I want to jump to a lesson that I read in a book from Munger on the weekend.
Mm-hmm.
And so, again, talking about Steve, he recommended Richer, Wiser, Happier in the Facebook group by William Green. And it's excellent. I really enjoyed it. Reminds me of, it's a book of where each chapter is a interview with a famous investor. And that might sound pretty dry. And a couple of them are just straight out, this is what I did, this is how I made money. But I'd say the majority of the book is more than that. It's not just about making money. It's about the extra dimension. It's about helping people. It's about giving back, all those kinds of things. So it's actually a really good read. But I came across a quote from Munger, which I love. And I just wanted to read it because it's so pertinent to what we do. This is from page 202 if anyone wants to look it up. And it says, Munger's approach to solving problems backwards was influenced by Carl Gustav Jacobi, or Jacobi, Jacobi, a 19th century algebraist who famously said, invert, always invert. But Munger tells me that he also honed this mental habit of inversion with help from his friend Garrett Hardin, an ecologist who shared his fascination with the dire repercussions of shoddy thinking. Munger says Hardin's basic idea was if somebody asks you how to help India, just say, what could I do to really ruin India? And you think through all the things you could do to ruin India, and then you reverse it and say, now I won't do those. It's counterintuitive, but it really helps you to reverse these issues. It's a more complete way of thinking a problem through. In 1986, Munger delivered a commencement speech at an LA prep school attended by several of his 8 children and stepchildren. Instead of trotting out the usual bland platitudes about the secret success and happiness, he provided an inspired illustration of how to apply the principles of inversion. He gave the students a series of prescriptions for guaranteed misery in life, recommending that they should be unreliable, avoid compromise, harbour resentments, seek revenge, indulge in envy, ingest chemicals, become addicted to alcohol, neglect to learn vicariously from the good and bad experience of others, cling defiantly to their existing beliefs, and stay down when struck by the first, second or third severe reverse in the battle of life. And now just a few sentences now, I'll skip to the end. Charlie says, you have to do both, of course, in life, but this inversion of looking for the trouble and trying to avoid it keeps you out of a lot of messes. It's a precaution. It's like a checklist before you take off in an airplane.
So how does that apply to QAV exactly?
Well, it's a checklist, but I think it's really useful. I mean, that's how the Stock Doctor research came up with their financial health. Merv Lincoln took all the relevant ratios for companies that failed and inverted them. Mm-hmm. It's also, I guess I didn't formally think of things that way for the checklist, but they're there. You know, we don't want companies with high debt, so we'll score them with low debt. We don't want companies without a founder involved or a high share ownership of the board of directors. That's in there. So I think it's really useful, but I'll throw it out to people. Why don't we sort of ask people to come back with what they can, if they can give an example of an inversion of something that they think we should look out for. I find it particularly useful when I start to get tempted by, to buy Afterpay or to buy the current boom stock is number one rule I think of what not to do in the share market is to follow the hot thing, the hot hand. And that kind of leads you back to value investing, really. If you're not following the hot hand, you're looking for things which aren't hot, which are cool, which are cold, which is contrarian, and it's value. So
yeah, the fonts.
I'd like people to come in and let's add to a list of things not to do.
Not to do. Yeah, look, I think it is a fascinating way to think. What are all the ways that I could screw this up? Now, let's not do those.
Correct. Yeah. I think that's a really powerful way to look at this. And it actually reminded me of the first thing I thought of was the dot-com boosters. A guy called Henry Blodgett, I think was his name, and there was a female as well.
Yeah, I remember Henry. Yeah.
I've forgotten the female's name, but they were just internet boosters.
Yep.
And they just would boost any dot-com stock as it got close to the end of the 1990s. And then Henry was actually caught out in a tape recording or a quote or something saying that, the bank I work for asked me to pump all this shit, which I do, but they're really crap stocks. And he was sacked and became toast.
Yeah.
I think he's actually resurrected his career. I think he had a media company around, like a business magazine or a business podcast, and he sold it recently for a lot of money. So good luck to him.
Yeah.
But that was, if you, what not to do, it's to follow people who pump stocks, especially in the hot market.
It's Business Insider magazine that he then started. He got banned from the securities industry and then started a business magazine.
Right.
Well, I tell you, the thing that reminds me all of is I remember reading many, many years ago, back in my corporate career, these studies or surveys they do where they talk about the things that the most common regrets that people had on their deathbeds, which is,
right.
I wish I hadn't spent so much time at the office. I wish I'd spent more time with my kids and my wife, my spouse. I wish I'd traveled more. I wish I'd done this. And so I was like, okay, well, here's a list of things to design my life around, right? I'm not gonna be one of those people. I'm not going to be one of those people that says, I wish I had X, because at the age of 30, I decided to engineer my life differently.
But and if I apply it to my life, the inversion for me is I'm not going to be like the people who say, I just don't know about finance. I'm not going to worry about investing.
Yeah, right.
I'll just keep working.
Yeah.
I'm not going to be and I hung out with a lot of people at university who would say, oh, that's all for capitalists. I don't want to be a capitalist. But yeah, I mean, you reach a stage where you go, I don't want to keep working for someone for the rest of my life. I don't want to have that control given to somebody else. So you invert it. How do I get to release that yoke? And that's through investing.
Very good. Bit of wisdom. All right. Are we ready to get into some...
A good book, people. Richer, Wiser, Happier. Thanks to Steve for that one.
Good one, Steve. Ready to get into questions?
You want to do a pulled pork?
Oh, the pulled pork. Yes. It's not in my notes. Sorry. Pulled pork.
That's okay. Coincidentally, it's actually one of the questions. So we talked about doing the pulled pork on Aries Resources before I looked at the questions. Anyway, we can still answer the question.
Yeah.
So AIS we're talking about, and the reason we're talking about it, it's a reasonably large cap stock. It's about 400 million market cap. It's 1.4 million ADT, which is a good size for almost anyone. It's also scoring really well at the moment. I'm just looking up its QAV score now. It's 0.26, and these numbers are based on a download I did yesterday, which is Sunday, 12th of September, at a price of 18.5 cents per share. So some background on Aries Resources. It's a mining company. Its code is AIS, and it's a gold copper miner. And this is probably the most contentious thing for us in the whole analysis. But roughly about 60% of its income comes from gold mining and 40% from copper. There's a bit more in there for silver, but it has two mines, and one's a gold mine, one's a copper mine. Now, as you know, copper has broken its sell line in terms of the physical copper share graph. I actually wanted to raise that too. The copper futures graph is now back into being a buy. So that's interesting. It may foreshadow what the physical does, but we'll use the physical at the moment.
Hold on. Can we talk about that for a second? Because I looked at that.
Yeah, sure.
I looked at that this morning when I was doing an AIS blog post, and I didn't notice that. Copper
physical, I've got the sell price. It's about 9,400, and the current price is 9,356. And then copper futures, it's way above its sell line. So I've got the sell price for copper futures at about 3,888, and the price is 4,400. So it's been a buy for a while, but it actually is a buy again in that its high price and second highest peak make it a buy again.
So you're looking at the futures but not the physical?
No, I'm looking at both. So my point is copper futures is good to go. Copper physical is a sell.
Right. Yes. So copper physical, it's still below its sell line. Copper futures, It's above its sell line. So which one of those should I apply when I'm looking at AIS, for example?
Yeah, well, this is unknown territory for me. I'm using copper physical,
right? Because
futures is forecasting, right?
Yeah, right.
It's possibly where the copper price will go, but it may not. Yeah, but it might be an indicator.
So copper is still in a sell then, if we're looking at the physical chart.
Correct.
Okay.
Yeah. And then the question for us is if 40% of the company is, mining and selling copper, is it something we stay away from? And short answer is I don't really know. It's 60% gold, 40% copper. So it's slightly more gold than copper, and gold is still in its, hasn't reached its sell line yet. So I'm leaning towards saying it's good to go. But again, if you're conservative and don't want to be holding an exposure to copper at the moment, then I wouldn't hold this stock. But yeah, my thoughts are that it's 60% gold, so it's okay.
Yeah, Steve Mab sent me an email as soon as he read the buy list this morning. It was like, I thought this was a commodity sell. He's quick off the mark, Steve. Yeah.
And look, to be completely honest with you, I haven't had experience with this one, any sort of situation where there's a multi-commodity stock in my portfolio and what to do. So, a lot of it's going to be led by the 3-point trendline sentiment, I think, too.
Right.
On this one. Yeah. Okay, so that's the discussion about that. At this stage, I'm leaving it on as a buy. The share price has still been going up, even though it has got an exposure to copper. So that aside, the other thing to note about this company is there's lots of exploration going on. And it's an explorer, and it has a history of horse trading tenements, horse trading mines, buying and selling companies and mines and tenements. And that means the share price is largely going to be event-driven, I would think. So, I wouldn't be surprised if, they strike a good drilling prospect somewhere in New South Wales where these mines are based, and that boosts the share price. Or it goes the other way, that they've been drilling for a long time, finding nothing, and the share price goes down. So just wanted to call that out too. We are buying is making a lot of cash flow now and a lot of cash from its current mines, but it is also exploring a lot too. And the third point I wanted to make generally about the company, which people should be aware of, is being an explorer, it has raised capital, a lot of capital over the years. It may raise less going forward now that it has the cash flow from its copper and gold mines. But whenever I see a company which is largish, and this one has a market cap of $400 million plus, but the share price is in the sort of pennies, and this one's at 18.5 cents, it leads me to believe that they've done a lot of capital raisings over the life of the company. And so the share price is still a very low nominal amount, which doesn't mean a whole lot, but it means that people should be aware before they go in that they may have to stump up for a capital raising going forward. They did a capital raising halfway through the year, in fact, to buy out another. I think they bought out a shareholder in one of the mines they own, and also for exploration purposes. So there could be more. That's the last point I wanted to make about that. Also too, maybe that at some stage they consolidate so that the share price goes up, a bit like Maxi Trans, where it was trading in the pennies at sort of 50 or 60 cents, and now it's trading at $3.50-ish. This may happen for this company going forward too. So not that it'll mean much to us because it's the same company, just a different cut of the cake. QAV of 0.26, quality score of 64%. No founder owner in this one, but directors are holding 9%, so it's just below our 10% threshold for directors owning shares in the company, which is still pretty good, but I've scored it as a 0 on that one. The forecast IV is good for this company. It's greater than twice the share price. So the company is expected to grow its EPS by 22%, according to the brokers that track it. And that means that if we use the IV2 metric, I get a number of 69 cents per share using IV2, which means that we could see quite a bit of upside in the share price. It's trading around its IV1 number now, which I get as 18 cents. So it's probably fairly valued, even though it's coming up as a value play for us, and certainly being driven by its operating cash flow. So price to operating cash flow of 2.43 times, which is quite cheap. PE of 5. In this case, interesting ROE, 50%, which is very high. So I think that will attract investors to the share as well. You sort of traditional ROE style investors. Stock Doctor financial health is strong and steady. Doesn't pay a dividend, so 0% yield. So it's on the buy list. Aries Resources.
Well, everyone should do their own research because anything could happen.
Absolutely. Not financial advice. And as I said, it does have an exposure to copper if copper keeps going down.
Yeah. Thanks, TK. Now, questions?
Questions, yeah.
Very good. First question is from James. Uranium. Wow, it's rocketed up. Coal also on the move. Other resources tanking. Any more thoughts on getting onto these cyclical resource plays early to ride more of the wave, and whether the QAV process should be adapted or our stock selection within the process to reflect these cyclicals versus turnarounds versus slow growers, etc. Channeling Peter Lidge here. Thanks, James.
Yeah, so what he's referring to, I'll go from the end backwards. The Peter Lynch thing is that Peter would classify stocks in different categories and would still own stocks in different categories, but just construct a portfolio that way. Yeah, first thing to note is that copper and iron ore are commodities which are in their sell phases at the moment, but most of the other ones are good. So nickel, as James has mentioned, coal, uranium. I can't think of other ones, but there are other ones which are doing well. So it's not just that uranium and coal are doing fine. Look, it's a really good question from James, and we talked about coal, a few months ago when the coal price started to turn up. And I think the coal price, we actually may have talked about it when coal broke its 3-point trend line to become a buy. But I couldn't find a coal company to invest in that was on the QAV buy list. There were some that were slightly below, and I called those out at the time, and they're now well below because their prices have been going up. And the four big ones that we look at are Whitehaven Coal, New Hope Coal, Yang Coal, and then perhaps Coronado, which is a coking coal company. I haven't checked the coking coal price graph lately, but it's probably going to ride the thermal coal price up as well. So those four stocks, they're all, QAV scores which are very low. I did look them up. Yancoal 0.04, Whitehaven 0.02, New Hope Corporation 0.05, Coronado 0.01, and they have quality scores of less than 50%. So if people did decide to buy them below the buy list, great, because they are all doing well. my comments at the time were I wouldn't be buying them because thought process has always been that we'll always have commodity ups and downs and we'll always have stocks that trend based on that basis. But we tend to get an extra boost out of the ones which we can buy on the QAV buy list because they have a good quality score and they have a good price. So they're kind of like coming out of the starting blocks a lot better than the ones which don't have those qualities. And certainly if you look at the uranium companies, and there's explorers in the Australian market or stocks listed that mine uranium in the Australian market, they're all in their infancy in terms of there's no operating cash flow. None of them appear on our downloads because they don't have any operating cash flow. The exception is Rio Tinto, and it bought out a company called ERA, which was the biggest listed uranium miner, and coincidentally bought them out this year. So they would have had a positive idea of where the uranium price was going. But, Rio Tinto, the uranium part of Rio Tinto is absolutely swamped by iron ore, which is a sell for us. So I wouldn't buy Rio Tinto just for uranium. The other ones, I think the biggest might be Paladin. And this is not an area that I know much about, but I've done a little bit of research. Deep Yellow's there, Boss Energy, Peninsular Energy, Vimy Resources, Berkeley Energia, Marinica Energy, Lotus Resources, Alligator Energy, Toro Energy are the ones that bring to mind. All of them don't have positive operating cash flow. All of them are in your exploration mode, but all of them have very sharp price rises in their stock prices. So there's certainly a lot of good in what James is calling out here. The question is, do we take advantage of it or not? And, simply put, my experience in buying commodity stocks has only been when they're on the buy list. Occasionally I may have dropped down to a 0.09 or something like that to buy a stock. But yeah, I don't have experience at buying these ones which don't score well from a quality point of view or a value. Happy to run a test and see how they go because they're certainly all going up and they should all get an uplift from the commodity price increase, but I really have no experience about how far and how shaky the ride will be.
How is that any different from buying tech stocks, though? You're really just speculating that these things are going to do well, but it's not really value investing, though, is it?
It's not value investing by any stretch, although it could have been value investing if we'd gotten in early enough. So a couple of months ago when the coal price first became a 3-point buy, some of these were, I think, like the QAV scores are now, what I say, 0.04, 0.05, 0.02, but they were up around 0.07, 0.08, 0.09. So that would have been the time to buy them. But it may still be early days in all of those trends, and there could still be upside.
But I'm talking about these uranium stocks that you're talking about, particularly. I mean, they're going up, but you're back into that tech stock. Yeah, right. You're back trying to play that game, trying to guess basically what's going to do well. We're not in the guessing business. We're in the science business.
Well, except that the 3-point trend line for the commodity has been a good steer for us. For the iron ore stocks, we've made a lot of money out of them. So what I'm calling out is James could be right. I'm tempted to put a little bit of my portfolio into one or two of these and see how they go, because it may be that James is right. In the future, we decide that we're value investors and commodity traders. I'm prepared to ride, with two labels, or wear a suit with two labels, or wear two suits, whatever the metaphor is, if it makes money.
You'll end up looking like Ricky Bobby, just with a suit with badges all over
it. Yes.
Oh, I don't know, man. It's a slippery slope from there to Bitcoin. Then you got to buy Bitcoin as well.
Well, you could 3-point trend line trade Bitcoin. I don't know how that would go, but yeah, I mean, my experience with tech stocks, and I'll use those because I don't have experience with uranium or stocks that aren't on the buy list with coal, is that you make money until the last one wipes you out. Right?
Yeah.
Because they just change so quickly.
Yeah.
They just drop.
Yeah.
Yeah.
I mean, that's my comeback to people who, tell me to buy Bitcoin or Afterpay in days gone by or whatever it is. It's like, look, I understand that if you time it right, you can make money out of these things, but that's not the kind of investor Tony's taught me to be. I'm not a timing it right kind of guy. We've done well out of iron ore looking at commodities, but we were investing in businesses with a good track record that were making money, that were solid, well run. Yeah. We knew that because we could look at the numbers and see that they were well established, well managed, profitable businesses. I would be very reluctant to start taking a punt on these other businesses that we don't know about just because they seem to be surfing a wave at the moment. I know. It seems like a different kind of risk profile.
It very much is, I agree. And that's always been my experience too. Yeah, like the uranium stocks in particular. I mean, with that many explorers out there, that you expect there'd be some consolidation, which will mean winners and losers in the market at some stage. It's not my area of expertise, to quote Munger and Buffett, but hey, if James is interested, I'd love to know his experience and whether he wants to trade it and see. But it definitely is a trading strategy rather than a value strategy.
Yeah. All right. Thanks for that. Steve asks, I don't have a lot of spare time and I'm still trying to get my head around the spreadsheet. Did a download last night, was working through the NAs today. One of the new companies on my sheet was WMC, which I thought was Western Mining Corporation.
I did too.
When did WMC become Wiluna Mining Corporation? You know?
I don't know when it became Wiluna, but it came up on my download for the first time this reporting season, so maybe recently.
Right.
But yeah, I mean, the first half a dozen times I looked at it, I went, yeah, Western Mining, it's renewed.
Yeah, it's back, baby. Yeah.
But it wasn't.
No, different company that just managed to grab that share code. Anyway, so Steve continues, when I got to the qualified audit part, I found it confusing. Could you have a look and let me know what you think? This was the one I used. He's pointing to the Appendix 4E and the annual financial statements. And there was a statement in there that says, we determined this area to be a key audit matter due to the significant account balances and the judgment involved in the preparation of the value in use model as discussed above. Well, key audit matter. There's a flag. What did you think?
Not necessarily, no.
No?
I think it's fine, yeah. So I will walk through it though. I mean, James, our auditor friend, he must have his ears pricked at the moment. We've probably never heard people talk so much about auditing in his life. If we go to the ASX or Stock Doctor and download the Appendix 4E, which in this case is also combined with the annual financial statements in the same download. Sometimes they're separate, but often they're the same. If we just scroll down at the very start, you'll see this is the regular Appendix 4E type format where it goes through the key metrics of the company, revenue, net tangible assets per share, dividends, details of entities over which control has been gained or lost during the year, details of associated and joint venture entities, and then it says audit qualification or review. So every Appendix 4E will have this question the ASX or ASIC, whoever's getting this report, needs to answer. And in this case, WMC say the financial statements have been audited and an unqualified opinion has been issued. So that's enough for me to say it's not a red flag audit.
Right.
So I stop there.
Right.
But you can't, as Steve did, you missed that, or as I said before, sometimes the Appendix 4E for some companies just says something generic like the figures have been audited and check the annual report. If we go down to the bottom of the annual report, which is also in that same ASX announcement, the way I read the audit report is to look for the start, independent auditor's report, and the opinion. So the first thing we check for is that it gets a positive opinion. And this is to say that the auditors believe that the financial report gives a true and fair view of the company's financial position and that the figures comply with the Australian accounting standards and the corporation's regulations. That's the first thing that we have, is the first thing I look for. If we don't see that, it's a red flag straight away. But chances are it'll already be called out as an emphasis of matter. If we keep scrolling down, we see basis of opinion, which is just blurb saying that they've conducted an audit. And then it lists key audit matters, which they have to do as well. But a key audit matter just basically is telling people how they spent their time auditing the books. I'll come back to the key audit matters, but if we keep scrolling through, we then get down to other information, which basically says that the directors are responsible for the other information. And then it lists the director's responsibilities. So nowhere in that audit report, there's a couple of other paragraphs, auditors' responsibilities for the audit of the financial report, which talks about their responsibilities. And if you wanted to know more, they provide a link on what the Australian standards are for auditors' responsibilities. And then it goes on to talk about the remuneration report, and they provide an opinion about that. So nowhere in that audit report is there anything saying that there's an emphasis of matter. And that's what causes the red flag. So an emphasis of matter, as James, our auditor friend, pointed out, is where you'll see wording along the lines of emphasis of matter, perhaps foregoing concern, which means that the auditors are calling out the company may not be able to meet its obligations to pay bills during the next 6 months or 12 months. And there can be some other emphasis of matters that get called out for other particular things, like there might be disagreements about intangibles or write-downs or whatever, but they get called out there, and they're the red flags. The key audit matters, red flags. As we've spoken before about Apollo Tourism and Leisure, there can be some things in there which are worth exploring, and if you're super conservative, like I tend to be, you can red flag them, but generally it's just telling you how they spent their time. Now, the particular key audit matter that Steve called out is the first one, and it talks about how, let's see, I can summarise it quickly. The group held carrying values for mines of $135 million, and basically that an area of judgment around whether that carrying value should be maintained at $135 million or written down because of various things is what the key audit matter is talking about. There was another key audit matter in there about a similar sort of thing. Group performs what's called impairment assessments when events or circumstances change in respect to the particular mine, the Matilda Wailuna gold mine, and it's called a cash generation unit, a CGU. So it's basically the part of the business generating cash. And then again, the auditors have said that whether or not we should take an impairment on the carrying value of that mine, which is currently $225 million, was explored in great detail, both by management and by the auditors. So it's a key audit item. It's not listed as an emphasis of matter, and the assumptions made by management have been challenged by the auditors. So in my mind, it's right for the auditors to focus on these things, but if the auditors are satisfied that management have made reasonable assumptions, then I'm happy to not red flag this.
So the key audit matter just means that it's something that they focused on, but they're happy with it.
Correct. Yes. Yeah.
Good. Thanks. I hope that helps, Steve. Dave from Newey, very interested in the recent discussion reusing super to buy QAV shares. I'm wondering what implications this has, if any, for overall QAV portfolio management and potentially the returns. If I have a personal portfolio of approximately 20 QAV stocks and then I set up a super portfolio, should that also be 20? If the funds available for personal and super are significantly different, I could end up with 40 stocks total based on market cap, for example, Oz Super Member Direct being ASX 300 or ADT considerations. Wondering what Tony does or has done between his personal portfolio and his super portfolio. Does he just total the dollars in both and divide by 20 for individual position size? Could someone that has a reasonable difference in available dollars between personal and super stretch the total holdings across both to, say, 30 stocks? And thanks to whoever put forward the Member Direct option, the benefits of the club. I want to thank that person too because I think it was Gary from memory, could have been someone else because I started doing that as well. Good question, I thought. I hadn't really considered that before. I was treating them, my personal and my super portfolios, as completely separate domains. But what do you think, Tony?
No, I treat them all as one. So we have shares in personal name, shares in our family trust, and shares in our self-managed super fund. And I try and keep them between 15 and 20 overall. And that does mean that sometimes a super fund can vastly outperform or vastly underperform the other two portfolios. That's just, a fact of life. But no, I treat the portfolio in aggregate. So to answer Dave's question, if he wanted to buy 30 stocks, sure. I don't have a problem with that. You'll start, as the portfolio gets bigger though, you'll start to get more index-like in your returns. It won't be a huge burden, I don't think, to go to 30. So a question I think that Dave's alluding to is that let's take it to the extreme. So if I had most of my money inside super and a small amount that I invest outside super, for example, then and let's say if I divided the total combined by 20 and I could only hold one stock outside of super, I'd still probably do that. But if you wanted to just preserve that cash because that one stock outside of super might halve, before we sell it. And that could be a problem for you personally if you're looking to, for dividend investment flow or whatever from that one stock. I'd simply take the other stocks in the superannuation portfolio, maybe the top 3 or 4, and hold them outside of super. So those 3 or 4 add up to one position in the fund, and you're not introducing a new stock, but you are diversifying a little bit there to prevent any one stock from being a problem for you if you need that money. Does that make sense?
No, I'm going to have to think about how that works. So if you've got $500,000 in super and $50,000 in your private investing, so then you've got 550,000 all up that you've got.
Yep.
Divide that by 20, so you'd be looking to put 27.5 into 20 different stocks.
Yeah, and so that 50,000 sitting outside will get 2 stocks. Not quite 2 stocks. I'd still buy 2 stocks, maybe just give them $25,000 each rather than $27,000 each. And that should be fine. If you wanted to be really safe though, divide the 50 by, say, 4 and give yourself 4 stocks. 2 are new and 2 are in the super fund already.
So you just
so that,
yeah,
just in that, if you only held 2 stocks and one went kaput, depending on your circumstances, that might be a problem for you if you suddenly had $30,000 outside of super and not $50,000. If, for example, you're relying on dividends to pay for mortgages or living expenses or whatever.
Yeah, right. So if you already had a QAV portfolio in your own name of 20 stocks, and then you find out you can start investing your super fund, you would have to sell down some of your existing portfolio and consolidate it?
No, well, the first thing I do is just, if you had 20 stocks outside and you started investing in supers, I just buy again those 20 stocks.
But what you might have bought them like a year ago and they're not don't have a good QAV score again now.
Okay, if that's the case, then you can't do that. But you got to try and balance let's take this to extreme. So you've got personal stock portfolio, you've got a super portfolio. Say you got married and your wife had a portfolio, your kids have a portfolio, you have a family trust with a portfolio. Suddenly you've got 10 stocks of 20 portfolios, right? That's an index fund. So you don't want that.
No.
Right. So that's why I'm saying, yes, use common sense. If it's not currently a buy, don't buy it for your super fund, but try and start with the ones you already own, which are still buys, put them in super and then buy from the top of the list. So maybe you do, as Dave said, have 30 stocks, but over time try and, if you sell 2, buy 1, so you get back to a 15 to 20 stock portfolio.
Yeah, over time, like you wouldn't go out and just sell all those 20 today, but when they breach a sell line, you would start to consolidate it down. So your entire portfolio, your entire holdings across all of your portfolios is that 15 to 20.
Yeah, yes, that's what I do. And I found that the best way to run things. And just bear in mind that you'll have years where your personal portfolio might be as high as 50% above or below what your super fund portfolio is.
Yeah.
But overall, you're getting 20%.
Yeah.
Right?
Yeah, you have to look at it as one thing.
Don't be worried by the volatility.
Yeah. Unless, the money that you're investing in your personal fund, you need to live on. So that's got to be careful always of that. That's the nature of investing, right?
Yeah.
You want to be careful about investing money that you may need in an emergency tomorrow because it may not be there.
Mm-hmm.
Good. Well, thanks for asking that question, Dave. That's gave me something else
question.
to do.
Well done.
I have to rethink all my stocks now. Good. Okay, last questions are from Edward. No, I've got Mark after that. Okay, so Edward asked a question about AIS, but I think we've already dealt with that.
I think so, yeah.
His second question was, I know TK has discussed the effect of inflation on the share market. There is discussion on whether it's transitory or permanent, but I believe we are in for a more permanent rise in prices, which should ultimately lead to a rise in the interest rates, which some are predicting may occur towards the end of 2022. As a theme, it seems to me, we need to look at the companies that can potentially pass on any input costs to their customers and avoid industrials or high growth companies, e.g. tech stocks, and maybe look to invest in the insurers, banks, etc. I'm also conscious that the market will generally price in this change at least 6 months to a year before the actual event. Is the 5-year monthly chart sensitive enough to try and capture the shift in the share market before the stocks in those companies become too expensive?
Yeah, a lot of different things to unpack there. The first one is I agree with Edward's comments about inflation. I think it is coming, if it's not already here. And I'm hearing lots of comments from, various people. As you know, we have a raffle business, right, where we source cars, and we've been talking to other providers of other things to raffle off to raise money for charities. And, we're hearing that people are finding it difficult to source vehicles coming into Australia. There's bottlenecks already, which will drive the price up of those commodities. and we don't have a manufacturing base here anymore. So if we do become heavily constrained with, say, cars, just to pick that industry, and the price goes up, we can't manufacture them here. We've got to pay that price. So I think supply side inflation is coming if it hasn't already arrived. I heard this a year ago in the building industry when we went into the first COVID lockdown that they couldn't buy plasterboards and things like that from overseas. So there'll be more and more examples of that. Yeah, luckily we have our own food production here, so that may not be as much of an issue, but potentially things like fertilizers and chemicals might be. I'm not sure. So yeah, I think inflation's coming. Who knows what will happen when COVID subsides eventually, whether it will go back to normal or not. That's the $50,000 question that everyone's asking, from the Jerome Powell in the US to Wall Street to us as individual investors. But from my point of view, I tune that out. If it comes, it comes, and we'll deal with it when it comes. If it doesn't, it doesn't, and we'll deal with it when it doesn't. So, what will be, and we'll adjust ourselves and our actions based on that. So that's my answer to Edward. In terms of being able to forecast which companies will do well, two things on that score: that the stock market is full of people who love to say, get out of the market, go to cash, buy healthcare because the population's aging, buy ESG stocks because we're all decarbonising, blah, 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 et cetera, et cetera. As soon as people start to think that way, those shares tend to get bought and the price goes up. So it becomes a crowded trade straight away, and it doesn't become a useful way to invest. Not the least of which is because it's based on forecasting, which may not actually happen. So you're stuck holding a stock that you paid a lot for that turns out to be a dud and it drops again. So that's a real mistake, I think, in the share market. So as much as I agree with what Ed was saying, it's a forecast, and my forecasting ability is as good as anybody else's, which probably means it's a coin toss, and I'm not going to make investment decisions around that. So yeah, I think you're right, Edward, but I'm not going to change what I do based on that.
Whatever will be. Que sera, sera, or as we will now call it from now on, QAV, sera, sera.
What will be, and we shall see when it is.
Now casting.
Yeah, now casting, yes.
QAV,
thank you to the Governor of the RBA for that term.
Mark, last question. Mark says, TK watches for the big market cap companies come onto the buy list when their QAV score is lower down the scale, so just above 0.1. So instead of buying from the top of the list with higher QAV scores, he'll consider buying one of these larger companies with a lower QAV score, but still greater than 0.1 when they sneak onto the bottom of the list. For instance, in his 13/8 journal, TK was buying DOW ADT of 8.7 million, but the QAV score was only just 0.1. So I'm wondering how Tony chooses which big companies to buy that come onto the bottom of the top scorers list with a low QAV score, but still greater than 0.1. Cheers, Mark.
Yeah, so 2 points. So generally, almost always I'll buy from the top of the list. I just have to put my own ADT constraints on the list. In terms of the Dow purchase, I turned over a good portion of my portfolio this company reporting season, or a little bit beforehand, because of changes in commodities. So my exposure to iron ore, for example, had grown dramatically over the last few years. And so I had to buy a number of stocks during the reporting season. So I wasn't just buying the top stock, which, as you go through, normally you might trade one stock off your portfolio and buy one stock or two stocks, but I had to buy a lot. And so I was working my way down the list to the bottom, and that's why Dow got in my portfolio, basically. So that's the reason for that. But I have made the point from time to time that sometimes on the buy list you get a big share market cap company coming on, and it will only stay there for a while. And JB Hi-Fi it's a quality company. It's been around for a long time. And so I am tempted from time to time to buy that kind of company when it comes onto the buy list, even though it may not be at the top and it might be at the bottom. And as it turns out, JB Hi-Fi has dropped off our buy list again now. So we may not see it for a while back onto the buy list. So buying those kind of big brand names is, when they come onto the buy list, even if they're at the bottom, isn't a bad strategy as well, because it adds some quality to the portfolio, I think, going forward. So they're the two reasons, but the main one is I had to turn over a lot of stocks in the last month or so, and I had to buy down to the bottom of the list, which is why I bought Dow.
Right. So you're not deliberately starting with stocks on the bottom of the list. You're just going all the way down to the bottom of the list.
Yeah, given my ADT limitations, there were only, I think, a dozen or 15 on the list that I could buy this time around.
That was ADT, not ADD, if anyone was wondering.
ADT, yeah.
All right. Well, that's a full lid.
Yeah.
Thank you to everybody who sent in questions. Now we're in After Hours.
Yes, thank you. I was going to say, did you want to talk about After Hours? So sorry to interrupt you there.
It's all right. We're in After Hours where we talk about what else are we doing outside of investing for anyone who cares. If you don't care, turn it off. But I care. I want to know what Tony's into. He's always into cool stuff. What are you listening to? You've told us what you're reading. What else are you listening to, watching, doing, TK?
Yeah, I'm trying to find my list. I'll go from memory while I look for it. Watching some really good stuff. I mean, finished watching Mr. In Between. That was a great third series. It's not for everyone. It's violent, but sort of Tarantino-esque in a way. But yeah, loved it. Really good. And then I got recommended because of that, like Foxtel came up with a recommendation to watch Hap and Leonard. Have you seen that?
I watched the first episode of it when it first came out, but for whatever reason, I didn't keep it up. But it's got Michael K. Williams, right? Omar, who recently OD'd, sadly.
Yeah, I was going to say that. Yeah, one of your guys from The Wire. But yeah, I'm really enjoying it. Good first season.
Yeah, no, that's good. That's so sad. I was actually, what was I doing? I was on the phone to someone, and Chrissy, literally kicked my door open. I heard her scream, "No!" She kicked my door in. I thought, Fox had fallen out of a tree at school, but she came in to tell me that Michael K. Williams had died.
Right.
We loved him in everything that he was in. Such a great actor and interesting human being. But the character of Omar in The Wire, he was even Obama's favourite TV character. So for whatever that's worth, great character and well written and well performed, and as largely due to his performance, I think.
And he does a great job in Hap and Leonard too. Plays a gay cowboy.
Right.
It's almost like a noir set in the 80s thriller, but it reminds me of Thunderbolt and Lightfoot. Oh. That old Clint Eastwood movie. Yeah. Jeff Bridges' first movie.
I just watched that 6 months ago. Loved it.
Okay. Yeah, great movie.
Yeah.
Yeah, so that's really good. And they're starting to play Billions episodes again. They had to go into hiatus because of COVID in New York, but it's back. So the first 2 episodes are out for the interrupted season, which is good. Really good. Love Billions. I
haven't watched much TV this week, but I did start a show called Kevin Can F Himself. Have you heard about this?
No, but my brother-in-law's name is Kevin.
There you go. Did you ever watch Schitt's Creek?
No, I didn't like Schitt's Creek.
I watched a bit of it. Chrissy watched it all. She loved it. But the girl who plays the daughter in Schitt's Creek, Annie Murphy, I think is the actress's name, is the star of this show. And it's really fascinating. We've only watched a couple of episodes, but it's set up as like a sitcom where she's married to this guy called Kevin, and it's about the neighbours and his father, and it's a classic sort of 90s, 2000s sitcom where like King of Queens, basically. It's kind of like a King of Queens where he's this fat, lazy, beer guzzling man-child, and she's married to him. And it's all done sitcom style with a loopy soundtrack, and she's like, "Oh, Kevin," this kind of stuff. As soon as she walks out of the living room where his scenes are usually set into the kitchen or outside, all of a sudden it completely changes and it becomes, the lighting all changes to dingy, and she's murderous and suicidal. She wants to kill this guy. She hates her life. She's depressed. So it switches backwards and forwards between the sitcom and her real feelings when she gets out of the sitcom world about being married. It's really cleverly done, and she's great. Her performance in it is really stellar, so I can recommend people have a look at that. I also rewatched one of my favourite films over the last week, Secretary. Maggie Gyllenhaal and James Spader.
Yeah, the bondage.
Well, it's an S&M movie. She's a masochist, he's a sadist, and they get together and it's made in heaven, kind of. But I remember, I haven't seen it for 20 years, but it's always been one of my favourite films, and it held up really well. Her performance, his performance, really, really good. Disturbing and also funny at the same time. So the balance was really nice. But the guy who directed it, what else did he did? He's only made like 2, I think, other films since then, and both massive flops. So fascinating. I don't know how that works. You make like this cult classic film, and then everything else you do is shit. So yeah,
I can't imagine Secretary had a good run at the cinemas though.
No, but I think it came out in that era, like in the early 2000s. It was still sort of the era of post Miramax indie director, where there was a market, at least on VHS in an art house cinemas, for like edgy, gritty, auteur type stuff. But
and from memory, I think it was even marketed as like in the vein of Sex, Lies and Videotapes, the other Spader movie.
Yeah, as a Soderbergh film, an early Soderbergh film, I think, wasn't it?
Yeah, it was his first, I think. Yeah.
And Spader, like Spader's Spader. Spader does Spader, and he does a great job. He's just weird. If you hate Spader, then you won't like the film. And because David Simon, who made The Wire, the last series I think he did was The Deuce, which I told you about, was about porn industry, the development of the porn industry in New York in the 70s and 80s. She was one of the main stars of that, as she was a prostitute who then becomes a porn director. And her performance again was fantastic. So it was good to go back and see her when she was like 22 making this film. And she was really, really good. Anyway, that's me. What else? What are you listening to?
Bit of soul, Ruby Turner.
I don't know Ruby Turner. No, who's Ruby Turner?
Yeah, good. There's a good album called Live at Ronnie Scott's in the sort of Aretha Franklin, black soul.
Mm-hmm.
Yeah, really, really great voice.
I see she's...
Stay With Me, Baby is the standout track. That's the one I was searching for. You know, sometimes you get like an earwig in your mind, and I just sort of had that riff going, and I typed it in, and this album came up, and it's really good.
Good, I'll check that out. Speaking of riffs, Fox came up to my bedroom at like 9 o'clock last night, and he was like, Daddy, you know my favourite song is Can't Pass the People, Can't Pass the Hitman. And it was...
What's that?
Chrissy said he's just been in his room just DJing Spotify for the last hour. It's James Brown, Get on the Good Foot.
Okay.
Fox has this really, for a 7-year-old, like a very eclectic taste in music. So I pulled up a video, a 15-minute performance by James Brown of Get on the Good Foot from Soul Train from like 73 or something, 72, 73. And Fox and I sat there for 15 minutes and watched this performance, just this massive jam with him in the flames, and he's dead. He's doing the splits, and like James in his prime, wearing a blue one-piece bodysuit with heels. Just awesome. And Fox loved it. He thought it was the greatest. So, yeah.
It is. He is the greatest.
Yeah. But he's been...
I saw James Brown and his backing band in Melbourne, like in the late 80s.
Jealous.
They were getting old then, but they were so good. So good. And they had like the whole shtick of his mate from his youth comes on first and walks on the stage and takes the cape off James Brown. Yeah. That's his only job. Like them takes it off to the and the horn players all do the twirl of the horns in time with each other and take the steps to the left and steps to the right. It's brilliant.
The hardest working man in show business.
Yeah. Oh yeah, they start off with the whole intro.
The Godfather of Soul.
Yeah, brilliant. Really good concert.
That would have been his Living in America sort of comeback days after he did the Rocky, was it 2 or 3? 3, I think, Rocky 3.
Oh, no, much after that. This was about 88, I think.
Yeah, Rocky 3 was like 85, 86. So,
oh, was it? Okay.
So when he did Living in America, it sort of was a whole new phase of his career. I think he reached a whole new audience. He even came out with a quasi-rap album, I remember, in the late 80s, which was kind of funny. He tried to get on that bandwagon at one stage. But yeah, so Fox has been walking around the house for the last day just going, can't pass the people, can't pass the hitman. Little red-headed white boy channeling James Brown. It's gold. I'll tell you what I've been listening to, and then we'll wrap up. Been my working music for the last couple of weeks. Bebopovsky and the Orchestry Podjezdov, particularly their album Blood Veins of Noir York.
Okay.
It's basically, and I found out this is a whole genre through these guys. These are Russian guys, but there's a number of bands out there that all they do is produce Twin Peaksy music. You know, that sort of boom.
I love it. Angela Badalamenti.
Yeah, but you know the stuff that he does, particularly like Audrey's sort of sultry music, you know, Audrey in the original series. Mm-hmm. and that deep baritone sax that's just coming in, and the brushes on the snare and the hi-hats, this really moody, ambient sort of thing. There's this whole genre of bands that do this. They're basically just ripping off Angelo Badalamenti and doing these songs. And it's great. It's fantastic. So that's been my new thing. It's like I get this Twin Peaks vibe when I'm working all day. So check that out. Bebopovsky and the Orchestry Podjezdov. Bebop, Charlie Parker, Bebop, Ovsky, O-V-S-K-Y, Bebopovsky. Okay. They got a few albums out. I actually reached out to them because I wanted to get permission to use the music as the new QAV intro. I thought that would just, a little bit of like Twin Peaksy music would be perfect for us.
I wanted to ask you why I've never used my music in the intro. You don't have to pay any royalties.
What music is that?
For my 40th birthday, we got 4 hours in a recording session in a recording studio.
Where's that? Why don't I have that?
It used to be if you Googled my name, it would be the only thing that would come up is my YouTube channel. But yeah, there's a couple of tracks on my YouTube channel.
Why?
I'll send it through to you.
Jesus Christ, Tony! Why is it taking you 2.5 years of doing the show to tell me about that? Let alone I've known you for 40 years and you've never told me.
No, I've told you before. I have told you before.
All I can find now is QAV stuff from you.
Yeah, I know. It'll be. I'll send you through a link. It'll be saturated by QAV stuff.
I own your brand now. Tony Kynaston. Well, technically you own it. I run it. Tony Kynaston Music. Someone by Tony Hunter. Tony McTrent Kynaston. Quality at value. 3-point trend line. You need,
yeah, gosh, there's so much on stuff.
These are songs you wrote and recorded?
Well, we covered Midnight Oil's Hercules, and then we wrote one. I wrote one and we recorded that one called Power in These Hands.
Wow. That sounds like Christian.
I'll find it for you.
Is that Christian rock?
No, it was a Bruce Springsteen style song.
Ah, well, you need to write a song about value investing.
Get on up.
Power in your checklist or something like that.
Yeah.
Okay, yeah, well send that to me, man. That's it. It's not the Brunswick Street Band. That's not you, is it?
No, no.
I cannot find
We were called the Fabulous Flame Shirts.
Is that in the YouTube
I don't think that's on the... No. I don't think it is. Yeah.
Fabulous Flame Shirts.
Well, because the lead guitarist was walking down Smith Street in Collingwood and found these shirts with like flames on the side for like $5 each, so he bought a set for us.
Awesome.
We used to wear them when we played. Yeah.
Okay.
Yeah, it's pretty hard to find. I'll have to find it for you.
That is the best thing that's happened to me all day. You've made my day. I can't wait to hear that. All right.
Yeah. All right.
Well, that's the show.
Okay.
Thanks, mate. Stay safe. Enjoy your 5-man picnics, 5-people picnics.
Well, I went for a walk today and I thought I'll just check out Rushcutters Bay Park and see if it's safe for a picnic. It's just teeming with people, no masks. I think they must have also allowed personal trainers to have 5 people at their outside training. So it's just full of personal trainers running classes. Outdoor gyms are open, so 20 guys doing chin-ups all around the same area in the park. It's just, why you want to, it's like the COVID picnic. You just don't want to go there.
I was going to say, 5 people, you could pretty much have a QAV dinner in Sydney because that's about all the people that ever turn up to a QAV dinner when we do one in Sydney. Melbourne, packed out. Brisbane, packed out. Sydney, 5 people.
Okay. Yeah.
All right.
Including us.
Yeah, including us. Take care, mate.
All right. Thanks, Cam. You too. Bye.
QAV podcast is a production of Spacecraft Publishing Proprietary Limited, authorised representative of AFSL 520442, AFS representative number 0012927118. Please don't make any investment decisions based solely on listening to this podcast. This is presented as general advice only, not personal financial advice. We don't know your personal financial circumstances. Please see a financial planner before making any investing decisions.